10-year yield diving this morning, taking a major leg lower as we see bond prices ramp up. A few data points coming in slightly below expectations, still elevated, but lower than the previous readings. Karen Schenone joins us, head of iShares fixed income strategy. Hey, Karen, welcome back to the show. Good morning. Thanks for being here.
Happy to be here. Thank you.
So we're watching a lot of compelling action here this morning in the bond market, maybe related to some of these data points, but it's just been trending this way now for weeks. What's the simplest explanation for why bond bulls have run away with the torch again?
I think everyone's trying to reprice the economy. We're trying to figure out how quickly things are going to reopen, if inflation is here to come and here to be here for a while. So we've seen a lot of investors repositioning portfolios. They're using bond ETFs as some of the ways that they can help combat inflation, cut fees across portfolios. And we're seeing, as the yields have been really volatile this year, it's really hard to time duration. So we're seeing more and more people just using broad market exposures as a way to gain access to the bond market.
So, Karen, when we look at how this is translated into this real crunch of the yield curve, it's odd to see our stock market continuing to grind higher. It's largely been happening because there is very specific strength in one portion of the market, which is secular themes. But overall, that bond curve flattening is not something we generally associate with a particularly optimistic view on the economy, right?
Well, what we tend to see is the long-term yields are very linked with both inflation and growth. And I think what we're seeing right now is that questioning around where the growth is going to come from. We had the jobs report come out on Friday, and while it was strong, we're still about 6 million jobs below where COVID happened. So that's going to take us at the current rate of job creation another 12 months to get back to full employment. So I think as we've seen the economy reopen, things are still very unequal. And I think a lot of the market's looking for corporate earnings the next couple months, how those are going to shake up. And I think bond buyers are retrenching here. They're getting a little bit more nervous. They're more willing to add a little bit of duration back to portfolios in case that stocks have gotten ahead of themselves. So I think that return to duration and adding it back to portfolios is just one of the ways that people are navigating today's markets.
Karen, is there a feedback mechanism from the bond market that, at least that's kind of the way I see it, and it confuses me because there's two possible explanations here. One where I hear people say, well, the inflation risk is purely transitory, and so yields don't need to be to the upside, but then there's also this possibility that inflation is so sticky that it could impair long-term growth. So it's odd that we could have such different extreme scenarios pushing the yield lower. When do we get answers? What do we need to look for? Because, I mean, you look at crude oil, look at some of these other inflationary stories that look like they're just warming up.
Yeah, I would say that, and that's really the biggest question on people's minds. Is this inflation here to stay, or is it just temporary? So when we take a look at it, the consumer price index last month came in at about 5% change year over year, which is the highest it's been in many, many years. And a lot of that's been driven off of big ticket items. Used car prices have been accelerating, airfares, travel, anything travel related, as people are trying to take some summer vacations finally this year. But I think the real question is commodity prices as well. When is that going to end? We've seen prices at the pump really accelerate. So when you just take a step back and look at it, though, over the long term, the Fed is pricing to an inflationary target of a little bit over 3% over the medium term, but aims to get it back down to 2%. So what we could see happen is if inflation is stubbornly high, when we finally see the jobs data get back where we want it to come, the Fed could start hiking. Now, we looked at the dot plot that we got last time. We only saw about 7 of the 18 governors projecting a rate hike by 2022. So we think at least the front end of the curve is going to be anchored down over the short term. And so that really leaves investors thinking about, how do I reposition portfolios in light of inflation? A few ideas. You could go ahead and buy TIPS. Convertible bonds are actually one of the ways that you can help stymie inflation, because you're getting that equity market upside with some bond-like protection. So we've seen a lot of interest in ICBT, our convertible bond ETF. So the chart you're seeing right now is just the fixed income asset classes and their sensitivity to break-evens. You can see convertible bonds are actually very, very high in terms of some positive impact there. Followed by some other asset classes like emerging market debt. We're still seeing emerging market debt has some income to it. It's about 50 basis points wider than high yield. So it's another way that if you're trying to combat inflation, build some income back into portfolios. And that's a way that investors can navigate today's market.
Interesting to see emerging markets in there, the high yield kind of risk on theme as well that has been working so far. What to you right now among those look to be the most robust? I mean, we're going from history here. Obviously, this is every time is different. There are some particularly unique things about right now. No real pandemic data built into that historical analysis. How is it holding up so far? What do you think looks compelling as working this time?
Oliver, I would say stay diversified. What we're seeing is some people substituting out government bonds for TIPS. We particularly like shorter duration TIPS. Our ETF STIP has been one of the most popular ways where you're getting that inflation protection, not taking on a lot of duration. So we've seen people substitute out their treasury component for some TIPS. I would say be diversified with your income sleeves, both high yield. We've seen our Fallen Angels ETF FALN as a way to play that because it is about 25% energy bonds in there. So as we're seeing energy prices accelerate, that's helping that portion of the portfolio. And then I would, as we just touched upon with emerging market debt, that's one of the ways to play it. We've seen investment grade spreads are very tight here at just 80 basis points over treasuries. So we still see probably all the value is gone out of IG credit. So if you've got it, hang on to it, but it's not as compelling and cheap as it used to be.
Karen, on the high yield front, is being an outperformer in the past during these periods. I find that a bit analogous to what I described in stocks, where there is this push towards some of the higher valuation, riskier assets that do have these powerful growth themes. But eventually, if we're talking peak growth, that would find its way into those high yield themes at some point, or secular themes. How long does that take? I mean, I know that's a tough thing to think about, but how do we kind of gauge how long that type of hedge can work, whether it's high yield bonds or tech? I mean, tech is basically trading like a safety bond right now. It's extraordinary.
Yeah, when we take a look at the high yield market, we had about 5% defaults last year, and it was in categories that we hadn't really seen before: cruise ships, movie theater companies. And at this point this year, we're trending about 1% on or less on the default rate. So that's really come down. So a lot of the tight spreads that we're seeing in high yield are just a result of we're in a very, very benign credit environment because of all the stimulus that was provided to the market last year. And the yield curve is so low. So when you add that spread to it, you're just not getting as much yield. So we think hang on to the high yield trade going forward. We're not inclined to see a credit cycle happen anytime soon. However, if the Fed starts hiking and liquidity dries up in the market over the next 18 to 24 months, then that could be a trigger to maybe lighten up on the high yield.
Okay. Karen, thanks a lot for the details. Really like the historical analysis. Very useful stuff.
Thanks, Oliver.
Appreciate it. Karen Schenone is the head of iShares Fixed Income Strategy.